So I got called out in the comments of the video I posted yesterday, and shout out to this guy because I don't mind criticism. I don't mind genuine critiques and comments that have value. I think he wasn't just being a bad guy and just hating. I think he was saying something that he truly believes, so it was genuine. He said that I'm gonna get destroyed wheeling, and I want to take the time today to explain why I believe, and I don't even think it's just my belief, I think it's true, that you don't really get destroyed wheeling if you know what you're doing. And I've seen this criticism from multiple people because as I was studying it and learning it, I saw a lot of these comments. They say you have unlimited downside risk and limited upside. So we're going to cover that today, and we're going to explain why that is simply not true if you know what you're doing and if you're doing it on the right stocks. So let's get straight to it. Now, he said wheeling is a way to generally normalize market returns, which I could see. You know, if you're going down, you saw some puts. Maybe if you're up a lot, you saw some calls. I can understand that. But he said something that I think was completely off, which was that since I'm doing it on a leveraged fund, that I'm taking way more risk and that it's way riskier. And I just don't agree with this because of a few reasons. Number one, I'm doing it on a stock like SoFi or AMD, which I think these companies have a big upside, a big potential upside for the future, and that we're sort of just getting started. Yeah, we're up. Yeah, it can take a dip from here, but I think it's still gonna pass these highs. I don't think we're at the peak. I don't think we're anywhere near the peak for these two stocks, for this example. So I don't have fear in those. If they dip and let's say they go down 50%, you know, because the stock can go down 25%, and then the leverage will go down 50. I could still leverage into these more. I could still sell more puts, get more premiums, and get in at a great price. Another thing I do to minimize these risks is I sort of dollar cost average, but on the contracts. So I'll sell one put. Let's say I could sell 5. I'll sell 1 today, 1 tomorrow. If the week is still good, I'll sell 1, you know, like I'll sell Monday, Wednesday, Friday, and then I'll average in next week, or maybe I'll wait till the next week. And it depends as well, because if I'm selling 2 weeks out, I'll get them all within that week. If I'm selling a month out, I'll get a few this week and a few next week. And I try to average into these. And sometimes even I won't go all in. So if I can afford 5, I might only grab 3 just in case. So then if worse comes to worse, I still have 2 more I could sell. So that's one way of doing it. Another thing that people say is that you're capping your growth, right? Unlimited downside with limited upside. And once again, I think this is not fully true because I can sell some calls, but I'm only selling calls if I'm willing to lose that stock at that price. And also this dollar cost average theory, once again, where I can sell 1 call now, and then I could sell 1 call towards the end of the week if we go up crazy. And if we're down, I don't sell anything. I'll just hold. And I wait for those right opportunities to sell calls. For example, on AMDL, I got in at like $7 or $14. I don't remember, somewhere in that range. But I was selling $30 calls. I'm already up over $1,000 on 100 shares. So, you know, if I was going at that with size, it would be even easier. I only have 100 shares. If I was going at it with size and I was up $5,000, selling at a $30 call when it's at 25, that's still what, $500 for every 100 shares? So it's like, I don't mind taking my gains there. I don't mind. And yeah, it could blow to 40 or whatever, but you know, sometimes you have to be willing to take that risk. And that's a risk I'm willing to take because I took big gains on it. And that'll lead me into my next point, where people will say that leveraged funds are going to lose value because of the theta and because of how it works, where they trade options on these, and that's why they don't hold the same value long term as the actual stock. But that's the whole point. These leverage funds are designed to wheel, or to at least trade on, but I do it to wheel because I think it's way better. I've noticed with majority of these leverage funds, when you go out to the 1 year, that's when they start to fall off. So for a good year, you can wheel these and they're going to be outperforming the actual stock most of the time. But even if you don't, even if you go about it month to month, if you're at the money, selling real close to the money, you're getting higher premiums. I'm selling at levels. So anybody that trades should know levels. And honestly, I think anybody that invests should also know levels, because it's really good to get an understanding for where the stock is, the value is. So we have the bottom and the top. So like, let's say AMDL, I'm just going to make up some numbers because I don't have them off the top of my head. But if it was chilling around $25, you know, the top is 25 and then the bottom is, let's say, like a 18. So 18 to 25. I can sell puts at 18 and I could sell calls above 25. Now, I was selling calls at 30 because I was way above the money because I wasn't trying to get sold. But if I did, it is what it is. And then I would sell at 18 to be in that range. I actually think I sold below 18 too, but I'm not sure. But even if I sold at 18, I'm still at that bottom of the range. So now I'll sell a few of those. And then let's say a market crash happens. It'll go below 18, but that's okay. I took a smaller amount of shares that I can handle at 18, and then I'll average down. This isn't forever. Bear markets last, you know, anywhere from 2 weeks to a year. But bull markets can last a year to 3 years. You know, we've seen 3 years. Ever since 2022 to now, we've been in a bull market, pretty much. We didn't get too many, you know, we had the April pullback, but we've already, we had the April pullback, but we've already recovered since that point. So, I understand people's criticism on these, but I just don't think it's valid if you look at the long-term picture, and I'm a long-term person. This is why I only trade with a portion of my portfolio, because I am a long-term investor when it comes to the bigger picture. But I do like to build my portfolio, and I do try to help people out with growing their portfolio by doing this. And I'm not a financial advisor, but I think it's a great way between wheeling and leaps to add some extra returns every year to your portfolio. And I've been doing this for about a year now, and I'm up 22% or 24% on the year. And I'll start showing you guys my receipts too. You know, by December, I'll put up my receipts. We'll see how I did for the year, because I did just start it this year. But I made sure to look at these things when I was researching. I was like, if I do cap my upside, how can I minimize capping my upside? Oh, okay, I'll just sell. If I can sell 5 calls, I'll sell 1 or 2. And then if the stock goes really bullish, I'll sell a few more. Because at that point, when it just runs up, you should expect it to slow down at some point. So that's when I'll sell calls. I'm not going to sell all my calls at once on one green day. No, because I know that, you know, it can still run up a bit. And I'm not going to sell all my puts on the first red day, because I know it can still crash more. So this is the thing. And what I didn't get to say earlier was that when you're trading a stock like SoFi, AMD, even Tesla, I've been trying to get out of Tesla, but even with AMD and SoFi, when I'm trading the leverage fund of these, it's still staying in that range. So it might go up, you know, $2 to $4 on the regular stock, but then the leverage will go up $4 to $8, right? Or it'll trade between $4 and $8. Yeah, it's a leverage fund. Yeah, it has more risk, but it's essentially the same. It's just on a bigger scale. And the reason that I like trading these over the real stock is because sometimes they're cheaper. And then in other cases where they're not cheaper, they're still paying better premiums. You're getting a way higher premium for the same sort of trade. You know, as long as you can match up where that price is to the real stock and get a gauge for where the levels are, it's essentially the same thing. But yes, if the stock dips, yeah, you take more downside, but if you stay in it, you recover with more upside as well. So this is why I do leverage funds. I try to average 3%. So he said as well that, you know, you can't beat the market with it. But that's the thing. If I was trading the regular stock, I probably would just about be at the same as the market, maybe a little bit more. But with the leverage, I'm bringing in around 3% average. So realistically, I could probably do 30% a year. But I try to keep it conservative. I try to stay, you know, farther from the money and just keep those premiums, just keep collecting, because that's free money. And I also will be leveraged with some margin, which, you know, I don't recommend anybody to do. This is the risk that I like to take myself. But when you're leveraging with margin and you're selling puts, that margin doesn't count as being used until you get assigned. So if I just sell way deep in the money, 9 times out of 10 I don't get assigned unless there's a market crash. And it did happen to me with TSLL. But other than that, I've been able to trade. I haven't paid $1, not even a dime, not even a penny in margin. And I have the receipts to show that. Never paid margin. I got out of the Tesla shares before they got assigned. I took my loss on that. But that was because I did it out of fear, didn't understand the market. But now that I understand the market, now that I understand all these things that I'm teaching you guys, I have way more confidence in this. And this is something I want to teach people. I'm glad this guy brought up the comment. It's something that I want to educate people on and show you guys that it is possible to even beat the market with this strategy. Of course, it all comes with risk. Anything that you do in this market that's not buying index funds, you're essentially taking risk. So, you know, I know what I signed up for and I know the possibilities, and I'm going to try and educate you guys just as much as I educate myself on it, give you guys the knowledge that I can provide, and I'm going to document it. We're going to see how we do, you know. Shout out to this guy. And if you guys also have questions or comments, concerns, please leave them down below. I'd love to cover it, or even just, you know, just to let me know, even if I don't cover it. But yeah, other than that, I think that's going to be it. I think this might have been a lengthy video. I don't know. This might be my longest video so far. But let me know if there's something else I didn't cover, guys. I think I covered just about everything on that. I will do a part 2 if I need to, but I think I've covered the majority of it. So, as always, love you guys, appreciate you guys, and I'm out. Peace.